Hey, ChooseFI friends, this is Cody Garrett. I was recently on episode 517 of the ChooseFI podcast with the topic Maximize Your Wealth, Understanding Capital Gains Tax Strategies. During our conversation, Brad and I discussed various case studies regarding tax gain harvesting. So I want to share a brief video example, step by step, of each of those case studies we discussed. This first example is a married couple filing jointly. You see here, these are the ordinary tax rates for married filing jointly and the capital gains tax rates. These tax brackets are based on taxable income, which is adjusted gross income minus the standard deduction. You'll see that the standard deduction for a family filing jointly, and neither of the spouses are over age 65, so they don't get an additional standard deduction. We can see that the long-term capital gains tax rate is 0% as long as taxable income stays within $94,050. In this first example, they had no ordinary income, meaning they didn't have any W-2 wages from a job or net profit from business or any interest income, but they wanted to go ahead and take advantage of tax gain harvesting. So they went into their taxable brokerage account and they realized a long-term capital gain of $123,250. Their ordinary income of zero plus the long-term capital gain brought their gross income to $123,250. In this example, they didn't have any adjustments to income. So for example, they didn't contribute to an HSA. So gross income minus adjustments to income equals adjusted gross income, also known as AGI, of $123,250. Then they take their standard deduction of $29,200, which was up here. They subtract that from adjusted gross income to arrive at taxable income of $94,050. We can see here that the taxable income is all sourced from long-term capital gains. So if I go to the top right here, to the long-term capital gains tax rates, you can see that all $94,050 sits within the 0% long-term capital gains tax rate. This is what's known as tax gain harvesting at that 0% rate. So when we simply apply that long-term capital gains tax rate of 0%, they will pay no federal income tax on total income of $123,250, since it was all derived from those long-term capital gains. In this next example, they still have no ordinary income, but they realize long-term capital gains of $133,250, so adding an additional $10,000 of long-term capital gain. Going through the formula again, gross income is the same, no adjustments to income, which keeps their AGI at the same number, $123,250. They still receive the standard deduction of $29,200. That brings their taxable income to $104,050. Although their taxable income, all derived from capital gains, exceeded the 0% long-term capital gains tax bracket, that doesn't mean that all the long-term capital gains are taxed at the higher 15%. The first $94,050 is taxed at 0%, and the remaining long-term capital gain is taxed at 15%. So down here, you can see 0% tax on the first $94,050, and then 15% on the remaining $10,000, which equals a total federal income tax of only $1,500 on total income of $133,250. Which is a 1.1% average effective tax rate. In this next example, we're going to take married filing jointly again, but this family has ordinary income, one spouse earning $100,000 of W-2 wages. If this family only had ordinary income of $100,000 and then reduced that by the standard deduction of $29,200, they would have taxable income of $70,800. But we can see that that's below the top of the long-term capital gains tax rate of 0%. So in this example, the family takes advantage of this gap and realizes long-term capital gain of $20,000. Their adjusted gross income is now $120,000. You can see $100,000 of that is from W-2 wages and $20,000 of that is from the long-term capital gain. They reduce that by the standard deduction, and thankfully the standard deduction can actually be applied to the ordinary income of $100,000 and doesn't have to be applied to the long-term capital gains. So after the standard deduction, we have taxable income of $90,800. Again, $70,800 of that comes from the ordinary income and $20,000 from the long-term capital gains. Since we have different tax rates for ordinary income and long-term capital gains income, we'll have to calculate the taxes of each of these separately. Starting off with the ordinary income, out of the $70,800 of ordinary and taxable income, the first $23,200 is taxed at 10%. And the remaining $47,600 is multiplied by the 12% ordinary tax rate. So their total tax on their ordinary income from those W-2 wages is $8,032. Separately, the $20,000 long-term capital gains, their taxes are calculated separately using this bracket. Again, with taxable income being 90,800, that falls within the 94,000 of the 0% long-term capital gains tax bracket. So the tax on long-term capital gains is 0, and the tax on the ordinary income is $8,032. Putting those together, we have federal income tax of $8,032 on total income of $120,000, which is a 6.7% average effective tax rate. In this example, we also mentioned they had 2 children dependents under age 17, so they'll receive a $2,000 non-refundable tax credit for each child, so that equals $4,000. Again, a tax credit is a dollar-for-dollar reduction of taxes owed. So with total income of $120,000, $100,000 of that coming from W-2 wages and $20,000 coming from long-term capital gains, they owe only $4,032 of total federal income tax on that income, which is a 3.4 average tax rate. Moving to the next example, we have Anne, who is single in early retirement, and she's concerned with the cost of healthcare. To understand her cost of healthcare in early retirement, Anne heads to healthcare.gov/C-plans. She enters her zip code, continue, and it's just her, single in early retirement. She's age 50 in this example, female, and she's not eligible for coverage through her job. She does not have any kids. She's not pregnant, is not a tobacco user, so none of these. Confirm. In this next part, we can determine that if Anne has no income in early retirement and continue, she will not be eligible for a premium tax credit. That's because her household income will fall below 100% of the federal poverty level for her household size and where she lives. So she continues to see what the plans are priced at without a tax credit. In this example, she'll go to Filters and go to Bronze and apply those filters. We can see here that United Healthcare provides a health plan for $541.42 per month, which equals about $6,500 per year. But if Anne goes back into the steps and changes her household income, let's say to $20,000, she'll receive a premium tax credit of $673 per month, which is actually more than that health plan cost. So if Anne kept her household income, modified adjusted gross income, at $20,000 this year, she could have a fully subsidized healthcare plan. Although free healthcare sounds really nice, Anne also has some significant unrealized capital gains within her taxable brokerage account, specifically for investments she wants to sell anyway. Anne also knows about the standard deduction of $14,600 as a single filer, so she goes ahead and takes advantage of that ordinary standard deduction with a Roth conversion from her traditional IRA to her Roth IRA. Anne also notices that the long-term capital gains tax rate of 0% applies to taxable income of up to $47,025. So Anne intentionally sells investments within her taxable brokerage account with a realized capital gain of $47,000. Her ordinary income plus her long-term capital gain is $61,600 minus the standard deduction of $14,600, which can be applied directly to the ordinary income, which was her Roth conversion. And that brings her taxable income to $47,000, 0 of that ordinary, and $47,000 long-term capital gains. Since her ordinary income is $0 since it was eliminated by the standard deduction, she'll pay no tax on her ordinary income. And the long-term capital gain of $47,000, since that was all within this tax rate of 0% long-term capital gains, she'll also pay no tax on that realized capital gain. So naturally, no tax on ordinary income plus no tax on long-term capital gains, and will pay no federal income tax on total income of $61,600. But wait, there's more. When Anne goes to healthcare.gov, changes her steps here, edits her household income to $61,600, and continues, we can see that Anne will receive an advanced premium tax credit of $236 per month, which equals $28.32 per year. So now when she views her plans, Anne will pay only $300 a month for her health plan instead of $541. So this is one of the benefits that can be positively impacted by implementing tax gain harvesting. I do want to mention there are some negative potential effects of tax gain harvesting, including eligibility for student financial aid, IRMA, which are those Medicare surcharges after age 65, and also the taxability of Social Security income. I hope you've enjoyed learning about tax gain harvesting, and I'll see you around in the ChooseFI community. Thanks so much.